Record opens for the S&P 500 and the Dow Jones Industrial Average. Welcome back to Opening Bell here on Cheddar. Everyone, we're taking a quick look at the major averages here as we kick off today's trading activity. We had already seen some new record highs for the S&P 500 this week, and so we continue that here today. On Tuesday, you're seeing the S&P 500 open higher by about 0.4%, 19 points higher here on the day. And then additionally, the Dow Jones Industrial Average, you're seeing that up by about 0.25% right now, just about 97 points to the upside there. So we'll continue to watch that. The NASDAQ Composite tech-heavy average still higher as well by about 0.7% if you want to round that up. We're joined by Rebecca Walser, who's the president at Walser Wealth Management right now, to help us break down more of this momentum that we've continued to track. The S&P 500 opening at a record high, better than expected Q3 earnings across most industries. Rebecca, what do you see impacting the market right now, most notably as we round out this month of October?
Yeah, I mean, it's certainly not going to be earnings seasons, Brad, because obviously it's doing a lot better than expected. You know, we did see some issues with Facebook and Apple. I know we're going to talk about that, but you know, obviously earnings season overall has been a strong beat, a strong surprise, and for the most part, I think we see the level of those beats going down since second quarter and first quarter. Obviously, we've seen a slowdown in the second part of this year as far as recovery from last year-over-year numbers, but still the earnings are good. I think outside forces are the things we have to worry about now. China, real estate, inflation, outside forces, not company earnings.
And so you mentioned Facebook. Facebook posted strong Q3 earnings. The company noted that they will be focusing on building revenue through its creators economy, e-commerce, and the metaverse. I want to get your take on Facebook's revenue going forward, and could scrutiny over the platform's practices hurt them in the long run?
Absolutely. And so I think that obviously we had a miss. We had a miss of a 29.5 B versus actually the 29. And they obviously attributed to Apple's privacy policies, which basically changed in April of this year, letting people not track. You couldn't just track them without their permission. And so this was what the impact was. And so what Facebook is doing here is, obviously after Snap last week reported lost ad revenue and their stock really took a tumble 20%. Facebook preemptively also fell last week 5%, but it's up. It went up last night 3% in after hours trading, because really they had already sort of discounted that Apple revenues were going to be an issue based on the policy. And so what they're seeing here, Brad, is they're saying, hey, let's look beyond just ad revenue. Let's look to our creative content. Let's sort of look at Netflix's model, and let's expand and broaden our depth and breadth of services, and let's start reporting it that way. And that's really strategic for them and actually smart, given the fact that they have such a heavy reliance on ad revenue.
Yeah, certainly. As we were taking a look at Facebook shares here on the day as well, intraday, it looks like they are now down by about 0.2% for the company that just reported that mixed bag of earnings. Going forward from here, considering the amount of investment that is going to be earmarked for the metaverse moving forward, it looks like about $10 billion. They are among other tech companies that are also, though, citing Apple's iOS privacy changes as the reason for declining ad revenue. So does this change revenue expectations from social media companies more broadly going forward, or is Facebook, as well as Google and the duopoly that they have in the digital advertising space thus far, are they well insulated enough from some of the same concerns that some of the competitors, social media companies who rely so much on advertising for their business, that they are exposed to right now?
I don't think anyone is insulated, right? We could have, a rule change tomorrow that can completely change business models. So we're not always insulated completely, but obviously Alphabet, being Google, and Facebook have the tremendous lion's share of all of what we're talking about. And so when you have a privacy policy on an iOS platform that really changes how you can use these, what we call cookies, and track people and track their behavior and track what device you're using, that is a lot of data harvesting that is leveraged to present the right ad at the right time with geofencing and all kinds of very technical things. And so it will have an impact, Brad, and they absolutely are doing the right thing by leveraging and branching out and diversifying and not being so heavily reliant on just purely ad revenue. It's going to take them time. We should see some, diminution and potential revenues. But obviously also there's also innovators that look to see other ways we can track that data, harvest that data legally, to continue on to present those ads that give them so much revenue. So I wouldn't count them out, but I would definitely count them as being handicapped a little bit going forward.
Certainly. We've got the NASDAQ just about 70 points off of an all-time high. It has already hit its 37th record high for the year. So I want to get your outlook on some of the biggest tech names, especially as we're continuing to report or see earnings reported from them this week.
Yeah, well, I mean, I think, Brad, I was just thinking how many others is this going to sort of pare down to? And, we've seen all kinds of tech companies this year. I mean, and you take a look at Apple. Apple's a tech company. Look at all the new MacBook Pros they came out with. I just bought my son a new MacBook Pro right before the launch. And I thought, shoot, why did I do that? It's always something that is coming out that's making people say, oh, that should have been a Christmas gift, not a birthday gift, something like that. So tech in general is not going to be the sale that it was last year in 2020. It was really what allowed us to keep operating and keeping a lot of businesses, even small businesses, working in their self-employed world in a very different way. So I think people that have this over-reliance, obviously NASDAQ has been a tremendous performer this year, but if you look at the total overall growth percentages versus last year, I mean, tech really was the savior last year, and I don't expect that this year, especially, Brad, with the supply chain issues. I mean, people are not going to buy as much on their Christmas list if they can't get it by Christmas. This is just common sense. So we need more emphasis on supply chain and getting that fixed for the holiday season than anything else, or we can't expect tech to create miracles that Santa doesn't deliver.
Just a personal anecdote for your son, you may be able to return it and upgrade to the new one. I know I was able to do that even when I had bought one of the older models, and then the new one came out like 2 weeks later. So I don't know.
Good.
I don't know if that'll benefit you. But
that's great.
Yeah, absolutely. Also, while we have you, we got to talk about financials, materials, energy continue to be the top performing sectors this month. Which industries are you avoiding perhaps at this time?
Oh, wow. Well, I definitely see recessionary pressure. I know I'm the contrarian right now, Brad, with everyone saying the market highs, market highs, market highs, but I'm looking at the macroeconomic factors that are really bothering me. China's real estate, I know we're not getting true, accurate data out of China. I mean, why would we expect to? We see that their securities, go after our short sellers and actually even sued Moody's and won. So we can't expect the data out of China to be transparent and true. So I am still very worried about the real estate contagion. I'm obviously very worried about 5.4% year-over-year core CPI, which doesn't even include food and energy. I'm extremely concerned about the supply chain crisis, especially for the holidays. But I see energy and food security problems right now, Brad, and I think that the market is going to in turn take that into consideration. So I think that people need to be looking potentially at, taking and enjoying some of their gains and potentially being a little bit, a little bit more safe. The one thing I do always agree with is buy low, sell high. And if these aren't highs, Brad, I don't know what is.
If we do see some sort of profit taking and in a large wave, what do you believe that signals for, the rest of this year and then even going into early next year? I, naturally think about 2018 and what we saw on the tail end of 2018, where there was a lot of profit taking, especially in the tech sector, and that proved to be a major slide that we saw, a correction for the broader tech sector at the tail end of that year. And then going into 2019, we had seen major pressures on that same sector as the U.S. and China had entered into then some of the ramping up of the trade talks that eventually spun out into trade turmoil as well. So, how do we kind of mitigate some of those pressures if there is a large selling activity that comes into play?
You are hitting the nail on the head with exactly what you just said. I remember Christmas Eve of 2018 was a disaster, and it was only a half trading day. So let's not forget that. You're 100% right. I definitely am not advocating for a market frenzy, because obviously if we start taking profits and we start to see a sales trend and then we start to get tapering and then we start to get worse inflation data, some not able to get turkeys for Thanksgiving, and we start to see real Chinese problems in the real estate unwinding situation over there, Brad, that is a recipe for a potential disaster. So I definitely want to exercise caution here and let people know the sky is not falling, but it is not outside of prudence to say, hey, the market's done really well. We do have, we stimulated globally $25 trillion, Brad, after the pandemic. Mm-hmm. And the thing I worry about with tapering is if we do start seeing a recessionary spiral, we won't have the global fortitude that we had because we just raised $25 trillion. So, we have to be very careful of our reliance or over-reliance, I would say, on central bank policy, and really make sure that our markets in and of themselves can be sustainable. And that might look a little bit painful for a while.
Rebecca Walser, president at Walser Wealth Management, joining us here today. Thanks so much for the time and insights. As always, Rebecca, good to speak with you this morning.